All right. You good. I think we're good to go. All right,
All
man.
right.
So, hey, thank you, man. Thanks for like talking about this. This is something that I'm like really personally interested in. Just so you know, like I have single families, and I think we talked about this a little bit when we talked on the phone, but I have single families, and I'm interested in this gap between like residential investing and commercial investing, because you could go up to 4 units residential and then you're kind of hitting this cap, and 4 units may be like good and maybe good to stay on the, but I think there's an opportunity too to like move over, and there's this weird wide chasm between what clients know what they can do on the residential and the commercial side. You know what I mean? So
For sure.
personally, I appreciate you taking the time. But what like first and foremost, like maybe introduce yourself and just give me a little bit of like your background and what you do.
Yeah, for sure. Well, first of all, thank you for having me.
No problem, man.
Sales director for Plenti Financial. I put on my fleece today just for this.
You look
um,
cozy.
yeah, it's warm outside, but it's freezing cold in the office. We've been using it as a bunker during the heat wave. But yeah, so I head up the sales department there. We were formerly known as selltaxfree.com and 1031 Exchange Advantage. We had some investors come in the last couple years, and we've kind of consolidated and kind of transformed
So
into this
what's like,
new.
is your core focus 1031s and facilitating those transactions?
Exactly.
So I know there's some
Exactly.
other ancillary stuff that you guys do, right? Like some kind of,
Yeah, there's some answers. I mean, we help clients get into 1031 replacement property. There are a lot of
gotcha.
different things that you can do with that, and I'll speak to that throughout this conversation. But we help clients, we kind of take them all the way from not knowing anything about 1031, all the way through doing an exchange, finding the replacement property, et cetera. Not to say we only work with novice investors. We do transactions anywhere from $100,000 up to like 100 million plus. So we have a lot of large developer clients as well. But anyway, that's basically my job. Is I head up the sales department, and I head up I'm kind of like I'm our lead consultant. So as deals come through the door, we're owned and operated by an attorney, David Greenberger, who kind of taught me everything that I know about 1031.
And you guys are
Um,
local. You guys are here in Carlsbad.
yeah, I was gonna say we're down the street from you. Yeah, we're
Yeah,
like
yeah.
right off the 5 at Palomar Airport. Right.
Yeah, so that's a huge advantage. So if I wanted to like enter into a 1031, you guys can do some ancillary stuff, but realtors can kind of work with you to just facilitate the 1031, and I could work with you as a consumer to kind of just be that intermediary. What's the term for someone who handles that? What's the
Yeah,
right term?
it's a qualified intermediary or
Got
an
it.
accommodator.
Okay.
It all means the same thing. But yeah, exactly. The IRS requires when you do an exchange that you work with a firm like us. Doesn't have to be us. I wish it
Mm-hmm.
did.
Yeah.
But that's kind of our job, is to document that the exchange is being done properly. And also in the event of like a standard exchange, we are also responsible for holding on to the client's sale proceeds from the time the property is sold until it's reinvested into the new property. So we help with all that, and then obviously we're here on the phone to talk through the specifics, just because it's not anything that
So
the average person does not do it every day. So
So
we
speaking of the average person, maybe we should just like back up all the way to the beginning and really like define what a 1031 is and what the use is, and then we can kind of dig in from there. So what is a 1031? Like how would you define what a 1031 is and what it's like kind of what is it useful for?
Yeah, so a 1031 exchange is a tax break from the IRS that specifically pertains to investment property. It allows you to defer or really ultimately avoid paying any of the capital gains taxes that would otherwise be associated with the sale. And those taxes are both at the federal level and the state level, which I think is really important to mention here in California. State capital gains are like 13.3% here. So
California
anyway,
likes taxes, that's for sure.
yeah,
So they like their
California
taxes.
definitely likes taxes. Exactly. So there's that, and then the federal level, it's like typically 15 to 20%. So again, it's a tax break that allows you to avoid paying those. The official term is to defer them, but as long
When
as you
you
continue to exchange, they never have to
when
be paid.
when you say
Um,
defer, I mean when you say avoid would mean that you just continually defer and you don't really sell and cash out in it. At some point when you cash out, you pay taxes on it. Period. So right.
if you choose to sell and cash out, then yes. But as long as you continue to exchange the property, like if you just every time you sell, you're doing another exchange, and then you pass away. We joke in the office and call it swap till you drop. you never actually pay the taxes. The taxes, generally speaking, the taxes die with the taxpayer under current tax law,
Huh.
and your heirs would inherit the property at a stepped up tax basis, and all those taxes are gone. So it can be tax free.
Yeah, we should also probably define what is an investment property if we go that route, right? So because there is what you've got kind of three ways of holding property from a lending standpoint. You do. There's three ways that there's probably it's probably not this complicated on your end, but it's like we've got primary residence, where you live. We got a second home where you
Mm-hmm.
kind of split time, or ideally it's a vacation home. And then you got investment property. And I know how I think let's define like investment property as the IRS would see it.
Yeah, so investment property, first of all, I guess the main thing to go through here is that it refers to not only commercial real estate, which is like investment property by default. All commercial property qualifies for 1031.
Got it.
You also have residential property, and that can be anything single family, like you said, up to 4 units, that's being used as an investment. So like the bread and butter kind of exchange property in the residential sense would be like a single family rental or like a multifamily rental property. And it can even be used, not to get kind of complicated, but it can even be used on a primary residence if there is some rental portion there. And if there is profit large enough that it's not going to be covered by any of the primary residence tax breaks, you can use 1031. Like the classic example would be I live in a duplex and I own my duplex, and half of it is a rental and half of it is mine. And it's gone up $1 million or whatever while I've owned it.
Yeah.
I could use the primary residence tax break on my portion, and I could use the exchange on the other portion. But
So
yeah,
yeah, and so I'll use my situation for an example. Like when I got out of the Marine Corps and I bought my first property in San Marcos, right? It's when you live in the property, I guess the guideline is 2 out of the last 5 years, right? That's kind of
yep.
what I was hitting on. If you own or occupy the property 2 out of the last 5 years, you have an element of a how would you define that? Like
It's what you're referring to is the Section 121 homeowners exclusion. So if you're
exclusion.
single, you get 250,000 of profit tax free. If you're married, you get 100,000. I'm sorry, 500,000 of
I was gonna
profit
say, dang,
tax free.
yeah.
Yeah.
So 500,000 if you're married. If so, does that mean that if I lived there for a period of time, right, and then I moved, and before the third anniversary of moving, right, like where I still had 2 years in that window, say I'm gone
Mhm.
for a year to make it simple,
Yeah, yeah.
it's still that exclusion is still okay for that period of time. So
Correct.
there may be a circumstance where an agent or where I have a client who lived somewhere previously and they moved and they think they have 1031, they think they have a tax thing which is keeping them from selling that property, but they may be still in that window as long as it's
Correct.
2 out of the last 5 years.
Correct. And on that point, I always like to point out this is the kind of thing that's only really applicable in California, just because the prices have gotten so high.
Yeah.
But the dream scenario for somebody is to actually have, if they have profit where it's not going to be covered by that
Exclusion.
500,000 or 250,000 exclusion. The dream scenario is for you to have lived there 2 of the last 5 years, so you qualify for that, and B, have then rented the property out in the year or two or whatever prior to you actually selling. That way you qualify for both tax breaks. So you can take in, if you're married, 500,000 off the table tax free,
Right.
and then you can do an exchange on the remainder of the property value.
You're
So
kidding me.
yeah, so it's a great tip.
I had no
Again, kind of
idea.
only comes into play here in like New York and some of the really high appreciation states.
Luckily, this is where we're at.
Yeah, exactly. Right. So every once in a while, clients will call me, and I'm like, "Wow, you hit the lottery! That's it."
I had no idea it was either or.
Yeah.
I had no. Sorry, it wasn't. I thought it was either or. I thought it
Right.
was either this or that. But you can kind of qualify. You can do both exemptions. You could 1031 a portion, and you
Yeah.
can
No.
homeowner
Granted,
exempt.
exactly. Granted, I mean, you have to qualify for the
Of
two of them
course,
individually.
of
Like
course,
it's
of
the two of
course.
the last 5 years, and then in
Sure.
the year prior to the sale of the property, it would need to be being used as a rental.
But if you knew that going in, you could kind of plan for that kind of thing too. And that's my frustration with CPAs. That's my frustration with a lot of planning is done in retrospect
Yep.
when what should be done is kind of planning on the front end and saying, okay, you're getting ready to do this. Here are your goals. What should we do now? in order to get you in the spot where it's like the
Yeah.
best case scenario. There's another thing that I want to mention because a lot of my clients are military clients. So are you familiar with any of that stuff? I'm sure related to how that changes for someone who would fall under the the Service Member Civil Relief Act or any of that?
Somewhat. I've had a client or two bring it up. To my knowledge, it does not affect the exchange that much, but I know there are other tax breaks and things that are available to
What's the
military.
occupancy thing? And I know this to be true. I don't, and I'm sorry I hit you out of the blue with it.
Mm-hmm.
But I had a client who was under those circumstances. He was not 2 out of the last 5 years. But as I was talking to him about it, it turns out that the reason for his move and conversion of it into an investment property was he was PCS moved with the military, or he was deployed. I don't remember what it
Right.
was, but that in essence, if that happens, that almost makes that 2 out of the last 5 years become almost indefinite.
Okay.
It's like it expands it like exponentially, and that's kind of a quirky little thing. That's kind of a cross section of what you do and I do. So, like
Yeah,
I said,
it's a great point though. I mean, there's a lot of military, yourself included, in San Diego, so it does come up. Yeah.
so all right. So if one of the biggest questions that I get quite a bit is this concept of like for like,
Sure.
like what are some examples or what are some guidelines around what you can exchange out of and what you can exchange into?
Yeah, so much like only investment property qualifies for 1031, um, it's the same thing on the replacement property end of things. So basically, they want to see that if you're selling uninvestment property, that can be, commercial, single family, multifamily, whatever. They want to see you get back into investment property. And on that point, I think a lot of people get confused where, I'm selling a commercial property. I think I need to get back into a commercial property to satisfy 1031. That's not the case.
Or they're
Um,
like, yeah, I have a single family. I got to buy another single family.
exactly. Exactly. And that's not the case. So you can exchange into and out of any different type of investment property that you want. It's really just the only thing they're looking for is that it is being used as an investment, whatever it is. Yeah.
What are some examples of like, what's the general, what's your like most typical, I know maybe there's not a, and maybe there's not a definite like typical client that you have, but
Mm-hmm.
what's something that you see a lot, right? Like what's a scenario? What are the scenarios that come across your desk that you see over and over that you
Yeah.
see as really, really like useful or really common?
Yeah, I would say probably the most common one is and again, it's a unique California kind of issue, but somebody who bought something during the crash. So it's, let's say they bought in 2010 or 2012 or whatever, and the property's gone up $1 million in value since then. So that's really common, and it's, they, whether or not they were using it as a primary first and moved out and now it's a rental, or if it was a rental from the get-go. They like exchanging out of those because the rate of return that they're making relative to the equity that they now have in this property, because it's gone up so much in value, doesn't really make sense anymore. So
Right.
it's like they'll, you could rent a property here. I'm gonna like way oversimplify, but you
Yeah.
rent
Yeah.
a
No, it's
property
perfect.
here for 3,000 a month, and it's and you bought it at, I don't know, 400 grand or 500
So,
grand.
so at
And,
that point in time, it was like a really,
oh yeah, it was a smoking deal at the
smoking
time.
deal. Yeah.
Exactly.
Yep.
But then the property goes up $1 million in value, just to over exaggerate. But now it's worth $1.5 million, and it's still only renting for 3,000 a month. And it's like you have this whole additional $1 million in cash that you could take and invest in some new property, or a
And
couple different properties.
cash flow $5,000 a month.
Exactly.
I know a
Exactly.
lot of people who just, man, it's so crazy. There's a guy who's actually a friend of a friend who was like a motorcycle or like an airplane mechanic in Anchorage or something. He was
Mm.
just like, he wasn't like, but he just bought a single family and then he like 1031 into a duplex. And
Oh
then he
yeah.
1031 into a fourplex. And then he timed some like, when he did the um, bought at the right time and was kind of
Right.
really smart about how he was objectively doing that. And that guy owns like, that guy is, I think he's in the process of buying some like 500 unit
Oh yeah.
building somewhere, and he's a multi millionaire from buying that single family and then just stepping up in 1031s.
Oh yeah, I mean, I think people who want to cash out rather than exchange. Granted, there are certain situations where it can make sense, emergencies happen and things, but generally speaking, it makes sense to pretty much always continue exchanging the property. And I don't say that from a biased
No, I
perspective.
get
It's
it.
just
I get it.
it's math, especially here in California. Again, the total tax bill that someone's looking at when they sell a piece of property here, like as a California resident, is typically between 30 and 40%. So if you kind of extrapolate that out over someone's whole lifetime, and you look at if they exchange 5 different times versus if they didn't, the amount of equity that they're going to have there is so much greater at the end, and the amount of equity that they'd have to put down onto a new piece of property is so much greater at the end if they continue to exchange.
You know what I find though too, man? Like I find that it's really for a lot of people much more about positive cash flow than it is about equity, you know?
Totally, totally,
So it's like, for me, getting out of the Marine Corps, I was like reading Rich Dad Poor Dad at the time. I was like, I was like
totally.
totally in this, like, I know exactly what I'm going to do. I'm going to just invest everything. I'm going to live on dividends. I'm going to live so lean. I'm going to buy property and live on the passive income. And I'm just going to like keep my means below this passive income. So I'm kind of like, I just don't ever have to actually work.
Mm-hmm.
Kids, kids, wife, business, house, all this keeping up with the Joneses hits you right in the face. And 10 years later, it's just like you're making good money, but it's active income.
Totally.
And so a lot of people are just like, how do I, like, especially for me and for a lot of real estate agents and people in like small businesses that they don't work for the government. They're not retired from the military. There's no Social Security is going to be dead, right? It's like there's no, and not like Social Security would make a dent anyways, right? It's like there's no income, and unless you're just saving a ton, which you should anyways. But like,
Right.
if you've got $1,000 on a rental property, positive cash flow, how much
Mm-hmm.
money would you have to have in the bank to have $1,000 in this market in dividends? So I feel like
Totally.
a lot of people, or interest income, a lot of people feel like the passive income is like they may 1031 up and have less percentage in terms of equity, but they're going
Right.
after that cash flow.
Right. Oh, totally. 100%. And I think too, like when people are contemplating whether or not to exchange and take the tax hit, what I always like to pose as a question if they're on the fence too, is, if you don't do the exchange and you throw away 30 to 40% of the profit that you have, I don't care what you put the money back into. It could be
Right.
new real estate, it could be stocks, bonds, whatever. How long does it take you just to make back the money that you decided to throw away, let alone like go into the positive? But
Yeah.
like that's kind of the evaluation. And yeah,
I also have like, I feel like if I was losing that money and I was going to charity, it would be one thing. But
totally.
if it's going to taxes, I get like this allergic response to it, man, just because I'm positive that it's going to something that's most likely completely useless,
Right.
unfortunately.
Right. Right.
Not to go down that road, but it's like, man, I'm just, anything that I can do to avoid, paying hundreds of thousands of dollars is just, yeah.
For
So,
sure.
I think what comes up for me personally is, man, it's tough, like, because especially in an inflated environment, it feels like you're going from one inflated asset, but you're going to another inflated asset also.
Sure.
But if you get that kind of cash flow in play, right, it's like it really, you know what I mean? It's like you're kind of covered as long as you're.
Totally. Yeah. And I mean, it's like they always say, it's like there's always a deal. It's just a matter of figuring out. It's a matter of figuring out what's important to you, and cash flow is definitely like a primary concern for people. I mean, you have people who bought something in Los Angeles or whatever, and it went up a ton in value. But if they want to go buy a rental in way inland Temecula or something, maybe that could still work for them, and cash flow wise, and future appreciation wise. I was going to say also, another major reason that people will exchange aside from just cash flow is that they're just tired of managing property.
Oh
I
yeah.
get a lot of people where it's like,
Well,
I've
what are
been
they
doing this
1031
20 or 30.
into?
Yeah, it's like I've been doing this 20 or 30 years. I'm tired of getting a phone call about a toilet in the middle of
Right.
the night. And so they'll exchange into at that point also your other option is just hire a property manager,
Yeah,
obviously.
for sure. For sure.
But you can it still results in some phone calls if you have an expense over
Well,
X, Y, and Z.
well, and like I said, on the commercial side, there's an ability to scale where you have one property manager that covers multiple doors.
Totally.
I could pay one property manager for a single family, and the portion of my revenue, the portion of my profit that goes into that it comes out of that property
Mm-hmm.
is big. But if I take that same concept, transfer that into a 20 unit apartment or something, and I
Mm-hmm.
have that property manager, that even if that property manager cost is higher, right, percentage wise of what's coming out of that expense, a lot of
Mm-hmm.
people, I think, the difficulty for me, man, is I was born in Hawaii, I grew up in LA, and I live in San Diego. So it's like
Totally.
I wish I had some, like, I've got buddies who are like grew up in Minnesota or grew up in like Ohio or grew up in Idaho or grew up,
Yeah.
and they've got like this real good, or back east or something, where they got these like little, like, perfect little towns that are off the radar, and there's
Totally.
like a bunch of little apartments there that you can pick up for under $1 million, and like,
Yeah. Yeah.
and I just like, my background is so much from these crazy expensive ridiculous places that it's hard for me. Where I was going with that is like, if you could pick an area, and take the money and carry it over to an area where you've got multiple properties in one, you could have one set of cleaners, maintenance people,
Totally.
all that stuff kind of service that one area.
Right. They're all, I
But
mean, they're all different schools of thought. I mean, I grew up in Pennsylvania, so I went to school in Pittsburgh.
yeah,
So I own rentals there. And it's in a way it's a blessing because cash flow wise, it makes a lot more sense. They
yep,
rent for like relatively the same amount as a lot of California, which is great. But for you, maybe it's a little tougher to get the cash flow, but you get the benefit of
the
owning
appreciation.
property in California or Hawaii or wherever,
Yeah.
and the likelihood of you getting appreciation over the long term is far greater than I would. So
Yeah, my thought is always like, okay, I have this property in California, and it appreciates, but the cash flow is difficult. So you
right,
you take that cash flow and and if it's long term kind of cash flow, bigger cash flow, you take it out of the state and get it into a state where, it's pretty landlord friendly, if
totally,
and because I went through I had the moratorium bite me bad this past
yep,
time during COVID. I got a tenant in my Temecula house that just stopped paying. But I'm like an empathetic guy. If he would have really been in trouble and had trouble and worked with me and stuff, it's like I always work. I have a good relationship with my tenants,
sure.
but this guy got a lawyer. He figured out what he had to do, the minimum, just to not pay for a year, and there was not a thing that I could do. So that, I
It's
think, is another
unfortunately
thing.
a really common theme that I'm hearing from a lot. I have a lady that I was speaking with earlier this morning. I originally talked with her last week, but she owns in South LA, and it's the same thing. It's like a triplex, and she can't get anybody out.
Yeah.
But it's a really common. I've seen a lot of people take money out of California too. I have plenty of people reinvesting in California as
Right.
well.
Right. Right. Right.
But I have a lot of people who are taking money out of California and going into the Texases and Floridas
Yeah.
and
I don't want to, I'm kind of not annoyed, but I'm kind of, to a certain extent, I'm like kind of tired of like the California hater thing. Like I'm really not super happy with like a lot of the policies as it relates to that kind of thing and
sure,
businesses, and making it really tough. But it's like I at the same time, it's like you kind of stick it out and do what you can to improve it as but
totally.
anyways, so can you um is let me back up. Uh if you got a like, for example, you got a single family, and you want to go out, but you want to buy a business, and
Mhm.
the business has real estate associated with it. Is that 1031 that you can do?
You can exchange into the real estate, but you cannot buy the business
Okay,
because
so
you can only exchange into physical real estate. Yeah.
got it. So let's say I've got a single family, and I'm interested in like an equipment rental company or something like that.
Hmm.
And the equipment rental company in Arizona has a lot with a building on it, and it
Yep.
has a bunch of equipment and a bunch of like stuff.
Yep.
The appraisal is going to be done on the land and the value of the real estate, right?
Right.
And the business assets like the all the equipment and everything else that's rented out is going to be excluded from that. The
Mm-hmm.
1031 can only go from real estate to real estate. Is that right?
Correct. Exactly. Yeah. So anytime I have clients, like I had a guy doing this with, it was like an assisted living facility,
Mm-hmm.
and he was selling one and buying another one, and I was just kind of instructing him, obviously within reason. You want to minimize the value of business and maximize the value of the real estate as it pertains to like how you're listing everything on the closing documents and all that.
Wait,
Just so you can
repeat that. Maximize the real estate value
you
and
want to maximize, yeah. So if you have like an assisted living facility and you got the real estate and the business is a part of it, you want to place as much value on the real estate as you can, of course within reason. It's if the appraisal comes back way lower, but generally speaking, that's the good way to do it, just because at that point you give yourself the opportunity to exchange out of more of the value there, and hopefully defer from tax.
if somebody owns a property with a partner somewhere, like let's say somebody has a single family that they own for again, and it's rented and it's an investment property, and they also own an apartment building, maybe like a 16 unit apartment building, but they purchased that originally with a partner and they own 50% of it, and it's never been mixed. It's like it's two separate people. Can you exchange out of a property into and buy out interest in that other property?
Yes, you can. You're not allowed to buy from a related party, but if it's just a friend of yours, business partner, something, that's totally fine.
Related, like family relationship?
Family relationship.
Yeah.
Yeah. They'll like call it all your lineal descendants, like anytime it's like mom, dad,
It's
brother,
like what we would call an
cousin.
arm's length transaction or a non-arm's length transaction.
Right. Exactly.
Got it.
I was gonna say on that point, as it just really quickly, I think it's really important too for all real estate agents, anyone who has a bunch of clients with investment property. This is a problem I run into all the time that I don't unfortunately don't hear about until they're about to close. But is planning the way that title is held, and on your point about partnerships and doing deals with other people. What I see all the time is that people will hold most primarily in like a multi-member LLC. They'll own like a multifamily property or whatever, and they'll put it in this multi-member LLC with me and two other partners or something.
Yeah.
The LLC is the taxpayer, right? A multi-member LLC, anytime you get above one member, it's going to be filing its own tax return. It's effectively its own individual in the eyes of the IRS.
Right.
So that is the exchanger. And what we see all the time is that people come to us at closing with, this title structure set up that way, but the partners want to exchange separately, which there are ways to try to get around it, but none of them are all that clean. All of them involve you running some risk, because the LLC is the one that really has been paying the taxes. It's the one the IRS recognizes as the taxpayer, and therefore they want to see that entire entity exchange rather than the individual members be able to go their separate ways. So if we have ample planning, and this is not like title change advice, we should
no, for sure,
we should consult about it first. But the general rule is that you want to get it out of that multi-member LLC and into tenancy in common with at least 6 months prior to the sale. So each owner that owned, in that example, 33% of the LLC would instead go directly onto the deed as a 33% tenant in common owner. And then they would file the income from the property each individually for their 33% share. And they could show that they as an individual, or they in their own single member LLC or whatever, owned 33%. And at that point, they can go their separate ways. But I see it all too often where you get a bunch of people that own a business together that want to exchange, and it just becomes all complicated.
Do you have any sense of like right now, obviously, well, do you have any sense of like for me with a bunch of clients that, and for people that are just consumers that see this, or for agents that have a bunch of clients, is there like a opportunity that you see, like not yes or no, but is there something that you would say, hey, if all agents or all consumers should keep an eye out for this? Or, I mean, it's kind of one thing to know that it exists there somewhere, but to be really purposeful about, if their goal is to kind of is I don't know how to frame this. Is like if you were in my situation, like what information would you be putting out, or like what would you want if you
Yeah,
could like say
I
society should know this, like,
yeah.
consumers should know this.
First and foremost, I would say society should know about the exchange from the get go. I think it's known as this, it's known as this like rich person tax break that all these huge, New York City skyscraper developers will use to
Right.
avoid taxes and whatever. It's just as accessible to the everyday landlord. I read a statistic years ago. I'm going to get the numbers wrong, but I'm in the ballpark. It's like 70% of single family rental properties are owned by mom and pop landlords who own like 1 to 2 units.
Right.
And so, arguably these people need the money, that would otherwise they'll give to taxes. They need the money more than the developer guy does.
Right.
Right. But oftentimes people are just confused about the exchange. It's not like it's kind of scary because it's a tax break. And so
Right.
it's like, it seems like this complicated thing. It's really not that complicated. That's what I would say is at first is just familiarize yourself
Well,
with.
kind of as
Yeah,
you're
yeah.
saying that, yeah, yeah. Sorry, just before, because I'm gonna a lot of those mom and pops probably could be a lot more proactive about growth if they had a real good understanding of it, because I think people's inclination is to just kind of let things lie when they don't understand it.
Right.
So getting a real good understanding of, it's weird, man. It's like, it's kind of like I always make this joke, no offense to like any divorce attorneys, but like I think every single divorce attorney I know is divorced, like,
Yeah,
again,
yeah,
no,
yeah.
it's just, not that that's a bad, good thing, whatever.
Yeah.
I'm in residential real estate, right? Like in the lending side. So all of my investments are residential, you know, and I've
Mm,
always wondered, like, man, I just have such a blind spot when it comes to commercial, and I can sit someone down and explain everything down to the small details of how the it's so easy with debt to income. Once you understand it and you can see it, it's like things
sure.
start, you can analyze things on the fly. And I've always been so, on commercial, I'm just so like, okay, so I got to figure out cap rate, I got to figure this, that, the other thing. But I feel
Right.
like it's the same thing. And way in 1031 is kind of, it's the same kind of thing. Like if you take a little bit of time to understand as it relates to your situation, kind of what that landscape looks like, you start seeing things differently and you see opportunities differently. And maybe when you drive past that duplex, you say, okay, wait, this is this, that's okay, that might work. And you look into it, and
Right.
that creates these opportunities, as opposed to just driving past because it's just kind of, because you don't know
Totally.
and it just sits. So to your point, that's a really good point, just knowing it exists, period.
Yeah, that and to put numbers behind it too. I mean, it's like it's amazing. It's 5.5 million properties, give or take, sell in the U.S. every year. You got a couple 100,000 commercial properties too. So round up and say it's like 6 million. Um, about 2 million of those in total are qualifying non-owner occupied investment rental properties. That's
Mm.
basically how the math works out. But only about 200,000 exchanges are actually done every year. So why is that?
Mm.
It's I think more so than anything, not every one of them has some crazy amount of profit that necessarily really warrants the exchange. But I certainly think it's more than 200,000, and
Right.
it's just kind of a lack of knowledge, in the with the clients themselves and just the real estate community really as a whole.
That guy that I told you about that was in the military, and he ended up paying us. That's the other thing. It's kind of up to you and up to your CPA to know the rules too. Because if you don't self-govern, what happened with that guy is he came down and sat down with me, and I was looking through his taxes, and I asked him about that sale. And he was like, yeah, I was outside of the 5 years. I was like, well, why'd you move? And he
Mm-hmm.
said, oh, I got a change of orders, change of duty station. I'm like, I'm pretty sure that that extends it, man. Like, and I dialed up my CPA. I
Mm-hmm.
was like, hey, man, this is this. Like, can you look at this for me? Long story short, he had already paid like 30,000 or so dollars, 30 something
Wow.
$1,000 in capital gains that was gone. It was in government
Wow.
coffers. It was gone. And that quick, like, kind of just like, if you don't catch it and you don't understand it for yourself, you can end up paying those capital gains away when you just shouldn't have, because nobody on the other end is verifying, right? And
Totally, totally. I scare people sometimes when I do these seminars because I'll tell them true stories about where clients have come to me and they'll say things like, my CPA told me this was illegal. And there's no knock on CPAs. There are a ton of great ones out there,
No,
but
for
these
sure.
are real things. They'll say that my CPA told me it was illegal, or my CPA, they'll call me up and be like, my CPA said I couldn't do this, but I just wanted to check,
Well, to your
or
point
something.
too, a lot with the number of people who aren't big developers and big New York
Totally.
skyscraper owners, these are all people that maybe they have one rental property, or maybe they lived in one, moved up, rented the other one out, and just don't know. And they
Right.
may be using H&R Block. You know what I mean? It's
Totally.
just they're filling out the forms. It's not anything. Or they may be in the military. They may be using base legal, and it's not any knock against any of that stuff. It's just like you may just ignorance is not, does not exempt you from the
Totally.
burden,
Well, I think also a trick with 1031, it has to be set up before you actually close on any of the sales or purchases involved in the transaction.
right,
So I think a lot of people don't really talk to their CPA until April. So
right,
it's like, if they did, even if they had a CPA that was in the know and that would have tipped them off, they wouldn't have found out until it was too late. So I always tell people, I'm like, probably the number one thing I've learned at my job. I learned a lot about real estate investing because people only exchange when they've had some success and the property's gone up in value. So
yep,
I learned a ton that way. But I always tell people, I'm like, the big thing I've learned is before you do any major financial move, talk to your CPA and possibly talk to like a specialist, like a tax specialist or a lawyer or whatever, about the specific thing you have going on before you actually do anything. And to your point, try to kind of plan ahead.
right, for sure. I wanted to see, because it's confusing to me too sometimes, and we can maybe there's a really simple dumbed down because the concept of, like, I think it's like the boot, the concept of like of your basis, the concept of like what goes in and what doesn't, the concept of like repairs or something. So
Totally.
maybe we could walk through a quick example of
Yeah.
like let's just do a full on hypothetical. Like someone bought a property a while back, they lived
Mhm.
in it for a while, but they moved on, they moved up, they rented that out, and the property's gone up in value. They've also paid the property down,
Sure.
right? And uh, um, and now they want to 1031 that, and they're trying to figure out what they have to move into to maximize the benefit of that 1031. So
Sure.
I know that may be a little complicated
Oh, no, no.
because
I do it all day, every day. I
okay,
can
cool.
definitely give
It's
you an
just
example.
complicated for me, man, because
Yeah,
I'm
no, no,
yeah.
no. Yeah, I whip math all day on the phone. So it's basically, let me think of a base number to start with. Let's say somebody bought a rental property for 500 grand, right?
Perfect. Perfect.
And let's say that during the 10 years or whatever that they've owned it, that now it's gone up and it's worth $1.5 million. It's gone up $1 million in value.
Okay.
I'm trying to use real-ish California numbers too.
Yeah, and
So
round numbers, because
yeah,
you lose me quick.
exactly.
Yeah, I got it.
Exactly. So you got $1 million in profit there. And I'm excluding things like depreciation and all this stuff. Just the simple math is you bought for 500, you're selling for $1.5 million, you have $1 million in profit. If you did not exchange, first of all, you'd be looking at taxes of like $300,000 to $400,000. That's
Well,
a
so
California
let's
rent.
break that down real quick.
Yeah, yeah,
So
sure.
I think you have short term, right?
If you've owned it 10 years, it's long-term gains. But
Right.
yes, yeah,
But you have the potential, like just stepping away from this example, you could
sure.
potentially have short term.
Yep,
You have an overlay of federal and state. You
yep.
have a percent, and short term would be just at income. You'd be
Short
taxing.
term is regular income rates, I believe.
Yep,
Whatever it is,
I
it's
think
higher than
so.
long term rates.
Yeah,
Yeah,
long term rates, and then there's an element also of, and just I don't want to get too far into the weeds, but there's
yeah, yeah, for
depreciation
sure.
recapture, right?
Yes,
So
yeah,
depreciation recapture, and that carries forward as well too, right? You defer the depreciation recapture,
correct,
correct?
correct,
Got
exactly.
it. Okay, cool. All
Yeah,
right, back
yeah.
back to the story.
But
Back to the
yeah, so
story.
just to give you ballpark numbers too to help paint that picture, federal is typically 15 to 20%, depending
Okay.
on the amount of profit you have. California has 13.3% at the state level. So right there, you're at like 28 to 33. And then you have depreciation recapture, and on any profit over, I believe it's 400 or 450,000, you have net investment income tax, which is another like 4%. It works out to be 30 to 40%. It's a
Is
simple way
that
to,
is
yeah.
that are are capital gains rates at the state level relatively similar, or is there an arbitrage by let's say my goal was like, look, at some point I do want to cash out, but
Sure.
California's at 13%. I know I'm stuck with federal because I'm in the US. But the capital gains rates in X state are far less. Like you have different states with different income taxes. You have
Right,
different
right.
states with different. Are there any states that create some kind of an arbitrage as it relates to
There,
capital
there,
gains
there
taxes?
are, there are,
Oh,
but
but California's going to get theirs.
bingo, exactly.
Oh, I knew it.
California has what is known as a clawback provision. So
Ah,
they track your
California and their
property.
claws.
Yeah, exactly. So if they'll track you, and if you leave and exchange into Florida, they won't charge you for a long time. But if you sold Florida without doing an exchange, California is going to come back and get
So
their
I'm
fee.
I'm guessing there's some kind of a document that you have to file annually or something when you're doing your taxes to show the disposition of that property, or when it sells you have to show that it's been sold so
Yeah, I
California
know.
can
I
come
know.
back.
There's one. There, California, as you fill out the 593 when you sell for the franchise tax board. So there's that. I don't annual reporting. I think you're right. I just don't ever deal with it. But
Right.
I think you're right. Yeah.
I'll bring my CPA on, we'll talk through some of that
Yeah.
stuff.
Yeah.
But and is it do you are you responsible for both, or
You're
is it?
responsible. You're not responsible. I don't think for both. This is CPA question, but my understanding of
Gotcha.
it is that if you exchange from 13.3% California into 9% Oregon or whatever,
Yep.
and you're living in Oregon at that point, you sell the property as an Oregon resident, you're going to pay Oregon, but
Right.
then California, I think, just gets
The
the difference
difference.
between the two. I think,
Okay.
but one way or another, you're paying the higher rate because you came out of California.
Ah,
Yeah,
man.
yeah.
All right.
But
Well,
this is the plan in advance stuff right here.
right.
So
And this is why
yeah.
what was the terminology that you
Swap
like?
till you drop, never pay the tax. Exactly. That's the name of the game. You can always, I mean, you know this better than me. You can borrow money out of the property and pay no tax. That's the
Right.
way to do it.
I
And
knew a
that's how
guy,
most rich people do it. They'll
I
just
knew a
borrow
guy,
against it.
I knew a guy who had a goal of buying a property on a 15-year fixed for 15 years in a row. And what he did, it was freaking
Wow.
brilliant. And he bought a property a year. He put them all on a 15-year fixed, and he bought 15 of them. So by the time the first one was paid off, he just refied that one, pulled it out. And then the next year, the second one came up and he refied and lived on that. And he just kept cycling these 15 properties was his goal. It was like a
Right.
crazy interesting proposition. I was just like,
It's
that is really
ambitious.
kind of a cool,
Yeah,
kind of deal.
for sure.
All right. So on that, in that scenario,
Yeah.
you can't just take your $1 million, defer it, and pay cash for $1 million property and have no payment, right? Like,
Exactly. So
how does that element of it work?
yeah, this is a really common misconception with the exchange. So in that example, again, you bought for 500, you're selling for 1.5
1.5.
million dollars in profit. Most people think they only have to exchange the profit. They only have to exchange the $1 million. It's not the case. If you want to get the full tax benefit, you would need to you're selling for $1.5 million, and you need to buy a new property worth at least $1.5 million, the same value as the property that you sold. And you have to also, all the cash equity from that $1.5 million sale, after you paid off the loan balance and the commissions and title and escrow costs, all that cash also needs to be reinvested into this new property that's worth at least $1.5 million. And you can make up the difference with either a new loan, or with cash from your checking account. It's another really common misconception with the exchange is that you have to get a new loan. You can add cash if you want. That's an option too. But yeah.
So just getting into like kind of making it more complicated, unfortunately, like, but that value, there's something to that, the basis, right?
Mm-hmm.
So it's not necessarily just the purchase price, right? Isn't it like there's a basis to it which creates
Right.
that gap?
Yeah, so your tax basis, generally speaking, is what you originally pay for the property, which is 500,000. And then on the depreciation point, you get the write off against any income you make from the property every year you're using it as a rental.
Yeah.
So every year that you have it as a rental, your basis, if you bought for 500,000, to oversimplify, let's say it drops by 10 or 15,000 every year
Yep.
that you're
Yep.
using it as a rental, as a tax shelter.
Yep.
So when it comes time to sell, your profit is the difference between that basis and whatever the sales price is of
So
the
it could be
property.
even though you bought for 500, that basis could be 400,
Correct.
and that creates a bigger,
More profit.
more
Exactly.
profit, more profit on paper that they can
Exactly.
it would be
So,
taxed
so again,
otherwise.
if you want to pay no tax, you have to go buy at least $1.5 million worth of new property, regardless
Or
how much profit you have,
multiple properties.
or multiple properties that in total are worth $1.5 million. You
Yep.
can also, if you want to buy less, you can, but you're going to pay tax on the
On
difference.
the
So
difference. Yeah.
if you bought for $1.2 million and you needed to get to $1.5 million, they're going to charge you tax on the
On the
300,000 that was.
300K, on the
Yeah,
300K. Yeah. Or you find a portfolio of 10 properties that make up $1.5 million, right?
exactly.
But you still have to have the same loan, and you still have to have at least the same purchase price.
You have to have the same purchase price. The
Not the
loan you
same
can
loan,
replace with cash
right?
if you want.
Right,
But
right,
yeah,
right, right, right,
yeah,
right. Well, because you could take a loan and pay it off right away and have it, so like you said, you have to make up that difference in terms
right.
I guess how would you think about like equity, I guess.
Equity investment is the
The
real,
term.
that's the real requirement. Yeah, reinvest all the equity and buy property of same or greater value and make up the difference with cash or a loan.
Okay, I want to do that exact thing. I want to buy a property. It's 1.3, right? So I'm 200 grand off, but that property could use 200,000 in improvements.
Right.
Does that is
So
that is that an option, or is that not an option? Or is that different?
it is an option. It does not always make sense, but it is an option. So in that example, yes, you could do what's called an improvement exchange. So you buy for 1.3, and then within the 180-day time frame of the exchange, from the time you close your sale until the time that the new property is closed, and in this case, construction's done, you have basically a full 180 days to close on the purchase of the new property and to complete any of the improvements that you'd like to have counted towards the overall dollar value of the property you're buying. And I'll just say really quick too, it does not go based on appraised value. I always get that question. I wish it did. It goes based on the purchase price of the property you buy, and then you get credit dollar for dollar for every dollar that you spend on improvements within the 180 days.
But that's where I see that huge opportunity from jumping to from residential to commercial also.
Sure.
Because there's such an opportunity, because residential real estate is based on comparable sales, and because commercial is based on that asset and the cap rate and the revenue, the of that property. You could 1031 into a depressed asset, use that cash in the 1031 to increase the revenue, do that loan, and then refinance and pull all your cash back out and keep that cash flow.
Totally.
That is just a crazy.
And obviously in that instance too, because it's commercial property, it's going up in value. It's a capitalized value of the property, right?
Right.
So a lot of people will do that.
But that's what I mean. That's what I mean.
Needs work, and then you increase the value of what you buy. Using
needs
tax-free
work could
dollars.
needs work could be adding storage to it where you charged additional revenue, or fixing the units so that you could increase rent $150 a month per unit.
Correct.
And then your revenue's up, so your cap rate's up. You go back to the bank, refi it, get your cash right back out based on an increased value that you put in with those funds.
Correct. And on
That's
just
insanity.
because you work in lending, so I'll go give you this proviso for that. The only way that the IRS allows you to do the improvement exchange is to have us as your accommodator, qualified intermediary, actually take title to the property that you're buying.
So is that like a reverse?
Well, it's close to where you can do it as their reverses are a similar structure, but not exactly the same. For the improvement though, it's possible to get a loan. That's something to be, clear about up front, because the lender doesn't want to see us on title and you on the loan. So you might have to get like a private loan or, something like that, you have to work with a lender that's comfortable.
Well, commercial lenders are much more likely to allow for unique make sense scenarios than like a loan that's going to be sold to Fannie Mae, which is relatively black and white.
Totally.
So, well, cool. So yeah, my last question, just as we're kind of like getting to the end, was about that, was about like similar. It's a good lead into like a reverse 1031, because a lot of times, like, let's say, like, for example, like right now, I don't really have, let me think about it. How do I frame this question? The question's about reverse 1031s, right?
Yeah.
And I'm trying to frame, because I was just going through this. I wasn't ready to sell my place because I had some tenants in it or something was going on with it where I needed a little bit more time, but I really wanted to buy this property now.
Yep.
You know, so the
Yep.
idea was that I couldn't sell before and get it with the accommodator and then do it. I wanted to do a reverse 1031 to acquire the property first and then sell the other one. And I kind of ran into a little bit of a hitch with that, but maybe like, can you talk to like the benefit and what a reverse 1031 is?
Yeah, for sure. So a reverse 1031 exchange is pretty much it's the exact same thing as a standard exchange. The reinvestment requirements are the same. You still have 180 days to get everything done. But instead of a standard exchange where you're selling first and buying second, a reverse exchange is where you're buying the new property first and then selling your property second within the following 180 days. I also, I mean, anytime clients have the funds to be able to do it, because you have to have the cash or be able to get the financing to be able to close on the purchase first.
Because you guys take title.
We take title, and again, we're required in this structure to take title to. You can do it in a reverse. You can take title to either the property being purchased or the property being sold,
And the one being sold is as collateral for the one being purchased, right?
Basically, exactly.
Basically, you guys want to protect yourselves by you, right?
Yeah, well, and more so even than that. I mean, it's just the way that the IRS wrote the laws.
I got it.
They need to see us take title to either the property being purchased or the one being sold without getting into any of the complicated technicalities of why that is. But I was going to say, as long as clients have a means of financing the property, if they have the cash or they can get a loan, I always recommend the reverse exchange as the better way to go. Just because when you do a standard exchange, we didn't get into the timeline too much, but
oh, right.
you're selling first. Yeah, you're selling first, and you trigger your tax bill the second you sell.
So
and you
real quick,
what's that?
Sorry, yeah. You go ahead.
Yeah. You have only 45 days from closing to actually identify to us as the accommodator what the new properties are going to be. So,
and then how long to close?
180 days in total to close. But the whole thing is with a standard exchange, it just creates a really stressful situation for you, especially if you're looking at a tax bill of over $100,000. You trigger it the second you sell, and now you're kind of forced to shop in a rush and under the pressure of the tax bill within that 45-day time frame. And if you don't find anything, you're out of luck, and you're stuck paying the tax. So the reverse alleviates all of that. You take as much time as you want to find the new property that you really like. You make sure you're able to actually close on it. And you do, and all you have to do is sell your existing property within the following 180 days. So
I'm wondering, like, if you have cash for the new one, that makes sense.
Yeah.
But if you have a loan, I'm trying to figure out how that would work. I think that was the sticking point for me, was just that I didn't want to throw 100% cash down on it.
Sure.
And I wasn't sure, there was some kind of hang up with getting a loan but you guys were holding the title,
Yeah,
that has to be kind of a specialized like loan, right?
Yeah. So we get a lot of reverse exchange. We do a lot of reverse exchanges. But I think a lot of the business that we get, first of all, we have like the lowest costs out there for them. We have a lot of it automated, but the main reason I think is that, again, when you do this structure, the IRS allows us as the accommodator to take title to either the property being purchased or the one being sold.
Got it.
Most accommodators, I don't know why, it is what it is. Most of them take title to the property being purchased.
Right.
And if that's the case, a lender will almost never agree to do a reverse because we would be on title and you're on the loan, and it messes up their whole collateral, for giving the loan in the first place. So as a means of solving that, we choose to take title to the sale property. We don't record it or anything. We just hold a deed really in our file.
Got it. So it doesn't trigger a due on sale clause.
Exactly. And the lender on the purchase isn't concerned because the client is still the one actually on title for the purchase. And
but they still need the cash outside of that. They still need the cash. They need to source the funds to be able to purchase that without selling the other one first.
Correct.
But they don't have to have cash in full.
Exactly. So if you have cash lying around, that's obviously a great way to do it. Clients will use bridge loans too. Like sometimes they'll get a loan against their, another property they own, or they have a HELOC on their primary residence, or they have some kind of line of credit on a brokerage account of theirs. Any of those other kind of sources of funds can be used for the purchase. And then when your sale actually closes, again, I'm oversimplifying a bit, but generally speaking, we'll give the money back to you and you just pay back the loan that you had originally taken out.
Makes total sense, man. Dude, I really appreciate it, man. Like, so So if anybody wants to like reach out to you and ask questions, you mentioned that you do classes and stuff like that. You do workshops or something,
Yeah,
or
we do workshops. We do a lot of stuff with real estate agents, and we
oh
do some
cool.
stuff with clients directly too. But majority of the advice that we provide is not tax advice, but
Yeah, of
the
course.
majority of the consultations that we have are just that. They're consultations over the phone. If you want to schedule one, you can do so. It's plentifinancial.com. And you can email me too. It's Justin at Plenti Financial. It's PLENTI financial.com. But just send me an email or go on our site and schedule a call, and this is what we do all day, every day, is help people kind of walk through a property that they have, how the exchange can work for them, what they can get into, etc.
Perfect, man. Well, thanks very much, man. It was super, super, super good info for me, man. A lot of that stuff is really like, even being in the business, it's like, it gets just funky, and having an
Oh,
understanding of
totally. Yeah. I mean, I
from
think the only reason I know it as well as I do is just because I've been doing it every day for so long.
right.
But yeah.
No, 100%. But what it helps me with, and I think it helps a lot of the people listening with, is like I mentioned to you, now it's like I can kind of think about some of the opportunities with my kind of book of clients where
Totally.
they may be kind of static, and I may be able to reach out to them and give them some information where it may make sense at some point in time to make.
Well, and I was going to say too on that point, just as the last, I didn't get to it earlier, but as a last point on a way to reach out to your clients, and this goes for any of the real estate agents listening too, doing like a title checkup to avoid that issue I was explaining earlier about, like, I have a multi-member LLC that's on title, or let alone a corporation, or whatever. Doing a title checkup just to make sure, especially when there's like any kind of partnership-ish kind of thing involved. Doing a title checkup to make sure that whenever it does come time to sell, that title wise they are prepared for a tax-free sale and to use the exchange in the first place.
Right.
Just because, again, I cannot tell you how many times I get the phone calls from people where it's, they're ready to close, it's not set up that way, and now I have to tell them, you run a serious risk of making that change within 6 months of closing on the sale. And if you would have gotten ahead of this a year ago, you would have been totally fine. So
Right.
that's another great reason to reach out to people, is just to make sure that's set up correctly.
Awesome, man. Well, thank you
Yeah.
again, man. I really appreciate you taking the time.
For sure. Yeah. Thanks a lot for having me. This was awesome. And I'm sure I'll see you one of these days. We're close
Yeah,
enough.
I'm gonna pull you in and like have you do some stuff for it. Like maybe we'll put a workshop together or something.
Yeah. That'd be awesome.
All
I'd
right,
love
man.
to. Yeah. But thank you for having me. Yeah.
You got it, man.
All right. Take it easy.